10 things to look at before you invest in any company. In other words, carry out some due diligence on your part before investing in any company that you're deciding to put your money in. Okay, so I'm going to walk you through, and these are some of them are already new, and some of them I learned from the great John Bogle. I've shared a video with you where I shared some tips that I learned from him in terms of investing, and now I'm going to share with you things to look at. So things to look at before you invest, or things to evaluate before you invest your funds in any company. And I'm going to look at 10 things. Okay, so if this is your first time on the channel, welcome and great to have you here. I hope it will not be your loss. And for those who have always visited the channel, thank you again for returning and for supporting the channel. Your viewership is very much appreciated. For those who have not yet subscribed, I will always say this until I see the numbers increase. According to my analytics in my back office, YouTube tells me that 75% of my viewers have not subscribed to the channel. So make sure that you are not among the 75%, but you are in the 25% that have subscribed. So if you have not yet subscribed, I'm waiting for you. After the count of 10, 9, 8, 7. Thank you so much. And drop in the comment that Yulin, you forced my hands and I've subscribed to your channel because you're giving me value. Thank you. Thank you for showing me some love. Much appreciated. So let me go into the 10 things now that you should evaluate before you invest your funds in any company. You should always look at the EPS, or earnings per share. The earnings per share is a measure of a company's profitability, calculated by dividing the quarterly or annual income minus dividends by the number of outstanding stock shares. The higher a company EPS, the greater the profit and value perceived by investors. So here's an example of how to calculate the earnings per share. The earnings per share is equal to the NI, which is the net income, minus the preferred dividends divided by the average outstanding common shares. Okay, so I'm going to share that with you. So suppose that for the fiscal year 2021, the net income, for example, ABC was 18.23 billion. The preferred stock dividends was 1.614 billion, and the average outstanding common shares stood at 10.196 billion. So the formula is, remember, the earnings per share is equal to the net income minus the preferred stock dividends divided by the average outstanding shares, common shares. And so if you look at these figures in this example, you have got 18.232 billion. That's for the net income, minus the dividend, the stock dividend, which is 1.614 billion, and then divided by the average outstanding common shares, which is 10.196. And when you minus 18.232 minus 1.16, it gives you 16.618, and then you divide that by the 10.196 billion, and that gives you an EPS of 1.65. So the earnings per share is sometimes known as the bottom line of a firm's worth. The earnings per share, or EPS figure, can help investors to gain an idea of the company's financial performance. And the EPS also demonstrates earnings stability as well as earning trend when compared over various quarters or years for the company. And the next thing you need to look at is the dividend yield. And the dividend yield is a financial ratio that shows how much a company pays out in dividends each year relative to its stock price. So it is a sum of the money paid regularly, typically over annually, by a company to its shareholders out of its profits or reserves. So that's what a dividend is. So this is the second thing you need to look at or evaluate when you are investing your money in a company. The third thing you need to pay attention to is the earnings growth. And the earnings growth is arguably the most important measurement of growth for a business, as earnings growth indicates the health and profitability of a business. It is a measure of the increase in a company's income in a particular period. For example, disappointment over slower earnings growth will cause the stock price to tumble. So the earnings growth is the third thing you need to look at. The fourth thing you need to look at is the volume. In terms of trading volume is defined as the number of shares traded in a particular period. So low trading volume can indicate a lack of interest in either buying or selling. This means that it could be bullish if it's low volume occurred in a downtrend line, and it could be bearish if it's noted in an upward trend line. High volume also gives investors more flexibility to determine when it's the right time to sell, since it translates to greater liquidity. So that's the fourth thing to look at, is the trading volume in a company. The fifth thing to look at is market capitalization. And market capitalization shows how much a company is worth as determined by the total market value of all outstanding shares. And a company's market cap will fluctuate with its share price. Investors can use market cap to gauge public interest and the company's strength. So again, the fifth thing that you need to look at is market capitalization. So just starting from the top again, just to recap, you need to look at the earnings per share. You need to look at the dividends yield. You need to look at earnings growth. You need to look at the volume in terms of trading volume, and you need to look at the market capitalization. The sixth thing that I want you to bear in mind or to evaluate when you're going to be investing in a company is the return on investment. And I'm sure a lot of you have heard this term before, ROI, ROI. I've ROI'd on my investment. I've ROI'd. So you are, if you're not familiar with any of the terms that I've just gone through so far, I'm definitely sure that you're familiar with the term ROI, or return on investment. And this is a popular profitability metrics used to evaluate how well an investment has performed. ROI is expressed as a percentage and is calculated by dividing an investment net profit or loss by its initial cost. So for example, you've invested $100 and it has given you a net profit of $30. So what you would do to get the ROI, you would put the $30 net profit divided by the $100 that you've invested times 100%, and that would give you your ROI of 30%. So 30%, the $30 that you've gained on your $100 represents 30% return on your investment. Yeah. The next one that you need to look at is market return. The expected return, market return, is the expected return or amount of money an investor expects to make on an investment given the investment's historical return or probable rate or of return under varying scenarios. The average stock market return is about 10%, as you guys know, as measured by the S&P 500 index. But that 10% average rate is reduced by inflation, which would probably take it down to probably about 8%, because I was going to say between 8 and 10%. Yeah, so, or change that to 8 and 10%. Returns are the difference between the initial price of an asset and the dollar value that has been generated after ownership has ended. So returns are the difference between the initial price of an asset and the dollar value that has been generated after ownership has ended. Number 8 is the price earning ratio, or the PE ratio. Some of you are probably familiar with the PE ratio. So it's the same thing, price earning ratio. And the PE ratio is calculated by dividing the market value price per share by the company's earnings per share. A high PE ratio can mean that a stock's price is high relative to earnings and possibly overvalued. A low PE ratio might indicate that the current stock price is low relative to earnings, right? So you've got the PE ratio. Then you've got the PB ratio, or the price book value ratio. And the price book value ratio relates to where the company compares the market value to its book value. So where the book value is the value of all assets minus the liabilities owned by the company. And number 10, which is the price sales ratio, or PS ratio, is also known as I said, the PS ratio is a formula used to measure the total value that investors place on the company in comparison to the total revenue generated by the business. It is calculated by dividing the share price by the sales per share. So just to recap and walk you through again, the 10 things to look at, or the 10 things to evaluate before you put your money in a company, the key things to look at, there are others, but these are 10 key things that you need to look at before you invest in a company. That's the EPS, the earnings per share, and I've shown you how to calculate that, and the dividends yield, the earnings growth, the volume in terms of trading volume, the market capitalization or market cap, the return on investment or ROI, and I've shown you how to calculate that as well. But I know you are bright sparks, so I know you guys know how to do that already. Then you've got number 7, which is the market return. Number 8, which is the price earning ratio or PE ratio. Number 9, the price book value ratio or the PB ratio. And number 10, the price sales ratio or the PS ratio. So make sure that you look into these things amongst many other things. You can look at their competitors. You can look at the industry. So those are 2 additional bonus ones that you can look at. And also the management of the company. So the additional 3 bonuses, one that you can look at is the investor, is the industry, the competitors, and the management team of the company. So those are 3 additional bonuses that you get. And another bonus one is the best time to start investing is when? 10 years ago or now. And so I'm sure you guys have heard about the dollar cost averaging strategy or DC method. And through the investment strategy known as dollar cost averaging, you can protect yourself from the risk of investing all of your money at the wrong time by following a consistent pattern of adding new money to your investment over a long period of time. By making regular investments with the same amount of money each time, you will buy more of an investment when its price is low and less of the investment when its price is high. To set up a DC strategy, you basically automate your investment process by setting up a monthly standing order of, for example, say $100 for those who use dollars as their currency in your country, or for us in the UK, we use pounds. So you put in, set up the standing order for £100 to go directly from your bank account to your investment account. So you do not interfere with that. And that goes out of your money every month as soon as you get your salary. So for instance, if your salary comes in on the, we'll say the 30th of each month, you would send out your standing order, say the 1st or the 2nd of the following month, so that your standing order is paid after your salary is in your bank account. You don't want the dates, get the dates mixed up, that your standing order is before your salary comes in. Otherwise, you'd be in trouble with your bank. So make sure that you set up your standing order after you get your salary. And so that comes out every month without you touching it because it's automated. And over a period of time, because investment, as you guys know, is over a long period of time. And you will see your money adding up each month that you're investing. And then obviously with the return that you're getting each year. Remember, investment is long-term, not short-term. Okay. And over a certain amount of time, say for instance, 5 years or 10 years, then you will see your investment pot building up very nicely. So what I will do is I'll show you in my next video in terms of investment, things that you can look at in terms of broker or brokerages that you can look at, and also in terms of factors that you need to take into consideration when you're investing. For example, like the cost, the cost that you'll be paying the managers for you to manage your fund each year, and other things, other financial data that will help you to make an informed decision before you invest. So my next video will be around that to help to guide you, because I know that it can be very daunting when you're starting to invest and you're thinking, oh my God, what brokerage do I use? Oh, what amount of money do I invest? Oh, what pot of funds do I put my money in? It can be a bit daunting. So I'll walk you through those information in my next video. Thank you guys for your time. And also, before you go, you know that there's nothing that you're going through today that you and God can get through together. You're great, you're awesome, you're wonderful. And I'll catch you in the next video. Take care. God bless you. Bye-bye.